U.S. markets moved today without any major headlines. SPY and QQQ dipped early, recovered into the afternoon, while Treasury yields continued to push higher. Let's break down what actually drove today's price action.
Starting with the S&P 500, SPY sold off shortly after the open, showing clear intraday weakness. However, buyers stepped in around midday, pushing prices higher into the afternoon session. This wasn't panic selling. Volume stayed relatively controlled, suggesting repositioning rather than risk-off behavior. The market tested lower levels, found support, and stabilized, a sign that downside pressure remains limited for now.
Now, looking at QQQ, we see a very similar structure, but with more volatility. Tech stocks underperformed early, reflecting sensitivity to higher yields. After the initial drop, QQQ attempted a recovery, but momentum remained uneven. This tells us growth names are still reacting to rate pressure rather than company-specific news. In short, today's weakness in tech wasn't about earnings or headlines, it was about macro conditions.
That brings us to the key driver, the U.S. 10-year Treasury yield. Yields continued to climb throughout the session, finishing near the highs of the day. This move puts pressure on equities, especially growth stocks, by raising discount rates. As long as yields stay elevated, markets are likely to remain range-bound, with rotations instead of clear trends.
Today wasn't about fear. It was about adjustment. Investors are recalibrating around rates, not reacting to news. The key question for the next session is simple. Do yields stabilize or push higher? That will likely set the tone for equities.